SoFi stock has been a painful one to own. Let's not lie about that fact, right? The stock has not done much, especially if you've been holding it for, the last 3 years or so? I mean, if you have bought it once and you never dollar cost average, then yeah, your position is deep red. Now, it's true that in the last 3 months, the stock is up nearly 30%. And yes, last Friday, finally, we saw a positive move. Stock went up 7.15%. Now, maybe next week, Monday, Tuesday, whatever, stock can suddenly be down another 5%. We've seen that before. Now, end of the month, we've got another earnings report, probably another double beat, maybe even triple beat. Stock might go up a little bit, and then we see the same story happen again and again. Stock goes up, followed by some more pressure on the stock the next couple of days. Remember, right now, short interest, 17.5%. So once this thing does start to move on the way up, we could start to see a small squeeze. Now, do I expect 100% moves, just like we've seen with Palantir, for example? No, probably not. Do I expect violent move once we near $10 because of that short interest? Probably yes. But with SoFi, what's the most important? The most important is to see that the business is still performing well. Profitability-wise, it is improving. To me personally, I want to get more information with regards to Galileo, the tech platform. More information, the better. And then, of course, with interest rates coming down, are we seeing now greater positive effects on the company? Previously, those were headwinds, now turning into tailwinds. Is guidance going to change a little bit, or are they still going to be sandbagging it a little bit to see what happens in the next couple of quarters, and then they'll update us accordingly? As long as that 2026 target of 55 to 80 cents earnings per share still stays the same, does not come down, I mean, why should I complain? I shouldn't, to be honest. I mean, we've seen the track record. You can see it here on the screen. It's been a pretty good track record, right? Okay, the stock is not going up, but the business is becoming better and better despite all the headwinds in the last couple of years. Business has become better and better. So let's discuss a couple of things about the business, about pricing, and a new announcements that the company has made. All of that in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. We really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So in the last couple of days, we've got this announcement right here. SoFi launches Directed Share Platform, or DSP, not DSP like advertising, but another sort, for US IPOs and capital raises powered by Primary Bid. So the Direct Share Platform, DSP 2.0, that will offer a modern and streamlined approach to equity program management for companies looking to raise capital in the United States. DSPs allow companies to allocate a portion of their share offerings to specific individuals or groups such as employees or customers. Now again, it remains to be seen, and actually a choice by those companies to see if retail will have access to future IPOs. It's not a given. Now, they say here with a potential rebound for IPO market in 2025, SoFi's offerings bring equity program management, IPO, and follow-up offering processes into the digital age. It also gives issuers enhanced flexibility in raising capital by enabling them to involve non-institutional investor groups at scale. We have here a comment by Anthony Noto. For decades, companies have wanted to offer the opportunity to participate in their IPOs to the employees, partners, customers, and others who have helped them grow. Unfortunately, traditional DSPs often have high account minimum requirements, carry significant costs to companies, and lack benefits to underwriters, limiting their appeal. SoFi now offers companies going public a turnkey, 100% digital way to offer IPO shares to employees and other people who helped build their business, and whoever else they want to direct the shares to, whether it's to 10 or 10,000 people. Now, we've previously seen SoFi offer access to certain IPOs through its app. So yeah, remains to be seen what happens. Of course, this is great from a consumer standpoint, from a company standpoint, just another feature that they offer, just another enhancement, which is great, which could lead, of course, to more potential big companies, big buyers, big users using the SoFi platform. Now, the impact of this remains to be seen. Moving on to the business side of things. So this was Q3 guidance. They expect guidance where revenue to grow around 20% year over year, an adjusted EBITDA margin of 26%, a GAAP net income between $40 to $45 million, and diluted earnings per share of around 4 cents. Now, if we look at the estimates, if you look at Yahoo Finance estimates, this is what you get for EPS. Current year 11 cents, next year 26 cents. And if we look at next 5 years, the growth rates there around 51.5%, which is quite a lot. And this is per annum, they say. Again, you know my feeling and my thoughts around those numbers on Yahoo Finance. I like to look at some other websites as well. Now, looking here at net income, if we take the September quarter into consideration, $40.7 million, and we look at the projections all the way to September 2025, this is a 138% growth for net income. Not too bad, right? This company is becoming slowly but surely a more profitable company. If we then look at total revenue, now year-over-year growth, and this has been a valid criticism, let's say, on the stock, or an explanation as to why the stock has not been moving much, is because the year-over-year growth rates for revenue has come down quite significantly. Yes, next quarter it's expected to be 22% growth year over year, but then we see here just 6.5% growth, 3.2%, and then after that we're seeing a reacceleration, 19.5% year-over-year growth and 18.5% year-over-year growth. Now, if the company, of course, update guidance and then beats it, and we see this year-over-year growth actually be higher, yes, I would expect the stock to react accordingly. And by the way, the estimates today are still a bit lower to what the company has said. So, yeah, that's also something that you have to think about. When you look at those estimates, you have to look at what the company said and what the analysts are saying, because sometimes it's not the same. Well, a lot of times, actually. Looking at gross profit and gross profit margin for SoFi, we've seen since Q3 2020, gross profit has grown by 543.5%. Compound annual growth rate, 64.2%. Not too bad, right? Gross profit margin, close to 83%. And that has been growing as well quite quickly. So yeah, maybe the stock has not moved much, but you cannot tell me and you will never convince me that the company has not become a better company in the last couple of years. If we look at the members, whether you like this metric or not, I mean, members have grown by 484% in the last 4 years. Then looking at guidance for the full year, management expects to deliver adjusted net revenue between $2.42 and $2.46 billion, which is $35 million higher than the prior guidance that they gave us a quarter before. This implies 17 to 19% annual growth versus 15 to 17%. This guidance now assumes lending revenue will be at least 95% of 2023 levels versus prior guidance of segment revenue of 92 to 95% of 2023 levels. We expect the financial service segment revenue to grow more than 80% year over year versus prior guidance of more than 75% growth, and for tech platform revenue to grow mid to high teens % year over year growth versus prior guidance of 20% growth. Now, again, for the tech platform, I do want to repeat it again and again. I want more information. We've been hearing about this for a long, long time. They've been saying, well, AWS of fintech. Well, if you keep on saying AWS of fintech, at least have something to show for it, right? Or stop saying that. Now, before going into the pricing, valuation metrics and stuff like that, let me remind you what Anthony Noto told us a couple of quarters ago. He said 2024 will be a transitional year. We thought it would be helpful to provide a longer-term perspective beyond 2024. For the 2023 through 2026 time period, we see 20 to 25% compound annual revenue growth, assuming no meaningful change in the macro environment and no significant new business launches or acquisitions, such as small, medium business checkings and savings, or small, medium business lending, a broader asset management business, insurance, a broader credit card portfolio, new technology verticals for the technology platform business, or new geographies. The 20 to 25% compound annual revenue growth from 2023 through 2026 assumes a compound analytic growth rate of 50% for financial service revenue, mid-20s for tech platform, and mid-teens for the lending segment revenue. Simply put, this growth only reflects the benefits of the investments we've made in our existing businesses, paired with continuing to build brand awareness, trust, and adoption by new members and driving cross-buy from existing members. He continued, the earnings power associated with this growth is notable and could drive between 55 to 80 cents per share in GAAP EPS in 2026. Moreover, we see 20 to 25% EPS growth beyond 2026, reflecting both the continued growth of the business we've just described, plus the added benefit from new business lines launched in the 2024 through 2026 time period that begin to scale and impact beyond 2026. Make no mistake, the long-term opportunity for SoFi remains unchanged, and we continue to believe we are just getting started. There are endless opportunities for investment and growth, and we remain focused on the right types of durable growth for this stage of our company and within the environment in which we operate. As long as these targets do not change, or at least not on the downside, I don't think we have to worry. But maybe that's just me. Anyways, remember, 55 to 80 cents EPS, GAAP EPS in 2026. If we look at currently, the EPS estimates December 2026 sits at 48 cents. Even December 2027 sits at 64 cents. Now, if we go from the 11 cents EPS estimates December 2024 all the way to 2033, the average growth rate is 35%. This is for EPS. If we look at revenue, that's closer to 11.8%. All right, so what can we do with that? Well, we can just play around a little bit. Now, this is pricing, not a reverse DCF or something like that. First of all, there's no free cash flow right now. And since they are in the lending business, free cash flow is not really the correct metric, in my opinion, right now to look at it. Anyways, if we look at what we've just seen, right? The EPS for right now, the EPS for 2033, and the same for revenue right now and revenue 2033. Currently, the current forward PE is 50x for the next 12 months. The forward price to sales, 3.4 times. So I've put here a couple of scenarios. Now, if we reach $1.64 in EPS by 2033, and we put here a forward PE of 30, we will reach a stock price of $49.15, representing 486% upside from the price we're at today, which is $8.39. Even if we look at a forward PE of 15, that's still 193% upside from the price we're at today, which is not bad. Now, if we look at sales, of course, a bit different, right? If you look at price to sales, not a lot of people do that, but since we're doing it, so let me show you that. Anyways, right now, the current forward price to sales, 3.4 times, right? The lowest one that I have here to come close to the PE, the forward PE metrics here, is 3.6 times based on that $6.74 billion in revenue. I don't know why that's written here EPS. That's supposed to be revenue. The best case scenario, or the forward PE of 30 here, is going to reflect a price to sales of 7.3 times. So yeah, I mean, for some, this might seem extremely expensive. For some, this might seem actually not that expensive and not that crazy. Again, this is $1.64, 2033. When in 2026, the company expects between 55 to 80 cents GAAP EPS. Of course, that's a big gap. And we've seen the estimates today are lower than that. So it might even be more than this. Now, again, what type of multiple will the market give SoFi stock by then? I don't know. But currently, knowing what we know, this is what you get. And yeah, it's been painful holding SoFi stock because, well, other stocks have gone up quite a lot, even fintech stocks, right? It's not like fintech stocks have not gone up. I mean, PayPal in Q3 was the best performing stock in the NASDAQ 100. PayPal year to date has been performing actually quite well because of the recent rise. Robinhood has gone up also. I think there are some other fintech stocks that have already started to go up. So it's not like, oh, all of fintech is not moving. No, certain companies, Block as well, Block has not moved 1 inch. But if we look long term, I'm a long term investor. Yes, I am down with SoFi right now, even though my average is below $10. I am still down because we're at $8.39. But if you tell me that in 2033, yes, it's a long time, it's 9 years, I'll be up close to 400% on my position or close to 300% on my position. Will I be sad? No. Only a greedy person will say and tell you, oh, that's not enough. No, not everything will be a 10x. And again, this is just one scenario. This can be updated in due time. Now, looking at the graph right now, as I've said, in the last couple of months and last 3 months, the stock has gone up. So we might have bottomed. We might have bottomed here at around $6.30 or something like that. Previously, when we were lower for a long period of time, it took around 63 bars until we saw, well, the stock go up. Of course, it then went down. We're used to that. Right now, up until the earnings report, it would be around 68 bars. Quite a long time, actually, since July 2023, so over a year, 476 days. Now, could this be the time? Could this be the time where earnings are very good, guidance is even better, and suddenly the stock does rise and does jump, and we go over $10 and we stay over $10? Maybe, maybe not. But what I do know is that the company has been doing very well. Management has been doing very well. The stock returns have not been great. But hey, management does not control the stock price. Management can control how the company operates. Then it's up to the stock market to decide whether or not in the short run they're going to suppress the stock price or not. Remember, in the long run, good companies will perform well. Bad companies in the long run will do very, very bad, but in the short run, even bad companies can perform extremely well. But there will come a point in time where the market will notice the difference between a good and a bad company. I think SoFi is in the good company category. I can be wrong, but the company will have to prove me wrong. So far, they have not. Anyways, that's all I've got for you right now. It's been quite a long video, I think. So share your thoughts, subscribe, like, do all of that, and I see you all in the next one. Bye-bye.